At the end of the day, how do we get better and how do we become better traders? So something that I want to bring up today is a little VIX masterclass. So first and foremost, it's a volatility index, all right? The VIX stands for volatility index, and it measures the expected volatility of the S&P 500. Now, the S&P, like we all know, guys, it's one of the biggest indices in the world. It's got a 40, $50 trillion market cap. It has ripple effects onto global economies such as the London, Tokyo, Australian markets, so on and so forth. So it's not to say that the S&P 500 is more or less important than the NASDAQ. It's just the most primary indice to look at and measure, because we know if we're going to have a 10% or a high volatile day on the S&P, that's also going to correlate to other assets such as the NASDAQ, the Dow Jones, the Russell, whatever it might be. So I just want to make that clear, though, even though it's only measuring, technically the volatility of the S&P 500, that technically it's also going to have a broad market effect, right? Because we know the S&P 500 has a ripple effect to every other market. Now, investors, traders, everyone uses this as sort of a fear gauge, and it's realistically, higher the VIX, the higher the number of the VIX is the more uncertainty. So what I want you all to do right now is pull up a chart, okay? So for example, this is just a gold chart. Go ahead and go over to your watch list. Just type in the top VIX, okay? And you guys will see the top one there. You got the volatility index of the S&P 500. This is the index CFE. You can use either of these, the index CBOE, whatever you want. They're realistically going to give you the same data within a couple of cents. Essentially, the higher it is, the more volatile. The lower it is, the slower, the cleaner the price action. So if the VIX is under 25 or under 20, that's not the lowest it goes, but a pretty good average. We know that we're going to have cleaner setups, easier price action. We're not going to have a higher probability of getting stopped out, and we can, trade our typical trading plan. Right? It tells us essentially if we should be playing offense or defense. Should we be playing with our full size position, or should we be going half? Should we be walking away or trading on our demo or trading on our futures, our funded, or should we be trading our live full size positions? Like, it's giving us a bit of an insight into the market volatility and what we can expect on not only the S&P 500, but the Russell, the NASDAQ, the Dow, whatever it might be. Okay. So why should we care about it? You know why. How do we use it to our advantage? Well, if the VIX is high, above 20 or 25, it means the market's going to be volatile. So avoid having tighter stop losses, because the chances are you will get wicked out, even if you have a high probability trade where you're following your rules, you're following your thesis, and you're doing, you're trading your plan, right? It's just another confluence that we can use and say, well, we're above 20, we're above 25. We know we could have some volatility tonight. Let's, lower our position size and widen our stop loss, right? So that we have a higher probability of staying in the game. And ultimately, you don't want to swing for the fences. You want to go for 1-to-1s, 1-to-2s, not 1-to-5s or 1-to-6s. Fast in, fast out, which is why you probably noticed me scalping and getting in and out on smaller time frames very quickly. I think my average trade time is about 5 or 6 minutes over the past couple of weeks, and that's because of the volatility. Right? I'm fast in, I'm fast out. I'm not, trying to swing for the fences. So if we're below 18, we know we have a calmer market. We can have tighter stops, because that's a more reasonable situation to have a tighter stop with your normal trade plan. You can look for higher risk to reward setups. You can then go for those 1-to-4s, 1-to-5s, and the market's going to move slower and smoother, so it's easier to trade in general. So if we go on the 7th of April and we look at the S&P 500 on the daily time frame just to make it easy, what happened on the 7th of April? That move there. Look at that. Right, you guys may not be able to see it, but there's massive wicks to the top, there's massive wicks to the bottom. And if we measure it, we go from the top to the bottom, we're talking 8% on one candle, right? So the VIX was at 60, we did 8% on one candle, but don't focus on the body, ladies and gentlemen. Focus on the wicks. Doesn't matter whether you guys were going long or you guys were going short. If you were trading on the 7th of April, you were getting stopped out. How using the VIX and getting an understanding of what the VIX is printing and having an understanding of the underlying fundamentals in that market can give you a step ahead as a trader. So if the VIX is high, if we're above 20, 25, and even if you want to say this is the medium down here, right? Look, that's 23. You can see if we're above 23, We're cutting our position size in half. That means if you trade 5 contracts normally, you go to 2 or 3. You know, you cut your position size in half, you widen your stop loss so you can allow for those wicks and allow for that volatility, and it means you're going to stay in trades longer. You're going to be able to stay in the game longer. You're going to be able to take profit because you're not going to get stopped out. Like, there's so many benefits of correlating the volatility and what the volatility index is telling us to the way that we're going to show up and trade as day traders on that specific day.